Most trading problems don't come from entries. They come from trading random stocks in random stages. That's why price often feels unpredictable. In this video, we will focus on strong stocks that have already moved out of accumulation and into the growth stage. And we will look at how opportunity continues to form there after strength is already established. Look at any strong stocks on your chart. Before a strong move begins, price typically spends time moving sideways. Supply and demand mostly balanced. This is what we call an accumulation stage. When price breakouts from this accumulation stage, demand has clearly taken control. That breakout from accumulation marks the transition into growth stage. And from this point onward, price behavior changes. Before the breakout, price is mostly non-directional. After the breakout from accumulation, direction becomes established. This is also where institutional participation becomes visible. Institutional money doesn't buy a stock in a one day, they build position over time. That initial breakout and follow through is evidence that sustained demand has already entered the market. Look closely at what often appears around the transition. A wide range price move and heavy volume. Very often this is the highest volume in the week, sometimes month, and occasionally the highest volume the stock has ever seen. That's not accidental. That's buying urgency. That's institutional stepping in aggressively. This expansion confirms demand and firmly establishes strength, but that urgency doesn't stay constant. After the first expansion, institutionals slow down. They don't keep buying with the same intensity. They pause. They allow price to move sideways. They allow supply to come into the market, and they allow that supply to get absorbed. That's why ranges, pullbacks, consolidation appear after strength. These pauses are not failure of the breakout. They are part of how supply and demand rebalances inside the already strong trend. I want to be very clear about one thing here. We are not talking about random stocks. Random stocks pause for random reasons. We are talking about strong stocks. Stocks that are already showing leadership. They tend to trend near their highs. They tend to show relative strength compared to broader market. That's not a rule, it's an observation. Strong stocks behave differently because demand is already active on them. Now look closely at what happens during these pauses. Price movement starts to shrink, ranges tighten, candles overlap, the supply and demand interacting. Sellers are offering stocks, buyers are observing it. When supply gets absorbed efficiently, price doesn't need to fall. That's why compression appears. These are not signals, they are footprints of supply being absorbed. Volume adds another layer to this picture. As price compresses, volume often dries up. In many strong stocks, this can be some of the lowest volume in weeks or months. At the same time, volatility shrinks, price becomes quiet. This combination, tight price, quiet volume, low volatility, tells you something important. Supply is becoming limited. This is not inactivity, this is absorption. If sellers were aggressive here, price would not stay this tight. As absorption continues, pressure builds quietly, and when that balance finally breaks, something changes. Volume expands again, buying urgency returns. Markets move when urgency returns. This behavior is similar to what we saw earlier. The context is different, but the pressure shift is the same. When supply becomes limited, price doesn't need much effort to move. That's what we mean by path of least resistance. Price doesn't move because of a pattern. It moves because there is less supply in the way. When demand steps back in, price can expand again. There is one more important context to keep in mind. Opportunities that appear earlier in the stage often behave differently from those appear much later. Early on, the stock hasn't traveled far yet. There is still plenty of demand left, so pauses there are often just allowing sellers to exit. As time goes on, more demand has already been used. That doesn't make later opportunities bad. It just means they require more care. This isn't about counting structure. It's about understanding where you are in the move. So when you focus on strong stocks in growth stage, you will notice a repeating process. Expansion, pause, absorption, the renewed expansion. These are not random movements. They are footprints of institutional supply and demand. They show how large players build position, pause, absorb supply, and then allow price to move again. When you understand this process, price stops looking random and starts looking logical. And that's where consistent opportunity tends to appear. In the next series, we will step back and look at the broader structure, how different stages form, evolve, and connect. Thank you.